Hi, and welcome to the Profit Playbook. I'm Scott Harris. I'm one of the partners at Green & Co Accountants. Today, we're going to be talking about income streams and how we can best analyze whether parts of your business are actually making money or potentially losing money. Today, who's going to be joining me to talk about this issue is Ed Gooderham, one of my fellow business partners at Green & Co. So let's get into it. So Ed, welcome to the show. Thanks very much for joining us. Today we're trying to talk about optimizing profit through identifying income streams, basically poor ones, bad ones. Would you mind just telling us a little bit more about what we mean by income streams, basically?
Yes, it's a strange term really for most people in business, isn't it? So income streams are the different parts of a business that we can break down. So if you wanted to pick a business that does a garage, so although everyone thinks you take cars to the garage, well, you might have MOT income streams. You've got perhaps just normal service work. Perhaps you're buying parts in for the cars to be maintained and fixed. And there's different ways that you can look at the income streams and see what margin you're making on the different parts.
Okay. So not all businesses tend to have income streams. There are different various income streams then, but some probably do, and they don't maybe realize it.
That's right. Some clients will have just one income stream. They do one thing and that's it. Other people might have them in different companies, which makes it easier in one sense because you've got one per company. Some clients, though, might have 4 or 5 different types of businesses in one business.
Yeah, that sounds like a struggle to manage, doesn't it?
That's right. And it's also very hard for the owner to actually understand where they're making money and where they're not making money in their business. So some income streams could be making very good profits for them. Other parts of their business, other income streams, they might be losing money, but they can't see it because they're looking at the overall picture. I mean, I've had some clients where they're turning over £7 million in turnover, and they've got 5 or 6 income streams, 3 or 4 of them actually losing money. And actually that client was making a huge loss. We're trying to delve into it and find out which part of the business were worth keeping and which parts you had to close was very important.
Yeah, so that was actually going to lead on to my other question. Why is this so important to identify these income streams? So a lot of what you've touched on there so far is it's almost identifying where you're going to lose money effectively or where you're going to make money. Is that a fair assumption?
Good question. Most people are in business to make more profit. So being able to identify the parts of your business, the different income streams where you're not making as much profit as you could potentially make is very important. And therefore we spend a lot of time separating out income streams in businesses, trying to get them to stop ones that aren't making profit or improving them. And one way of improving them is to look at the margins they make and see if we can change the mix or increase the quality and therefore increase the price. Sometimes people have had price increases and they haven't passed them on to clients. So therefore their margins have been slipping and therefore their profit has been slipping. And being able to analyze it by different income streams, you get far more into the detail of a business. Whereas if you looked at the business as a whole, you might think, oh, it's doing okay, because it's still making a reasonable profit, but they could potentially be making far more. And it's that potential is the difference that looking at your income streams makes.
So if you've got a business with different sources of income, or you feel that you've got different sources of your business generating income, and you're trying to grow the business, trying to maximize profit, this exercise is going to be really useful to you.
Definitely. And it all starts by having good management accounts where you can split it out and monitor it yourself. You might want your accountant to come in and help you initially to be able to split out the different income streams, but you want to be able to manage it every month to see, is it working? What other things can you do to it?
So if you was working with a client, how would you go about trying to identify different income streams in their business if someone perhaps doesn't really know if they do?
Yeah. So the first thing you do is just chat about the business. How does your income, your sales happen? Where's it coming from? What work is going into it? And what direct costs relate to each different income stream? That then gives you the gross profit margin you make per income stream, which is what I talked about earlier, the margin. And they're the important things first. Overheads, you then look at afterwards, because today we're looking at income streams, not profitability overall.
So Ed, what can be done to improve poor income streams or unprofitable income streams in your view?
So that's very important, because if you've got an income stream that's making a loss, you want to stop it or sort it out very, very quickly. Now, it might mean you need to stop doing that line of work. It might just mean you need to look at the prices that you're charging or even where you're buying your products from or what your costs are related to that line. In terms of poor income streams generally, most clients know what sort of margin they're trying to get in terms of a return when they're selling a product or the service that they're selling. And they just need to review, are they getting that margin? So it could be a markup or a margin of, say, 30%, 40%, depends. Every single business is different. And if it's not the level they think it should be, well, is it a case they've had price rises and they just haven't increased their prices? Is it a case that they, again, need to review who they're buying their things off or what costs they're suffering in terms of giving that service? It's all these parts of the business that if you've got a whole business with lots of different income streams, it gets lost in the ether. But when you've got each income stream analysed and you know exactly what income you got for that income stream, exactly what costs you got for that income stream, you can make these decisions. And that can make a massive difference to your business.
So working with a business owner, maybe they're trying to do this exercise themselves. They're thinking about margins, trying to work out if this is actually a good income stream or a bad income stream. Potentially all the income streams are making money. Potentially the margins are positive, but they can't identify if it's enough or not. Do you have any advice around identifying the ideal margin for a business in that example?
Problem is there's no ideal margin. And you've also got to take into account what overheads they've got to make sure they're making a profit at the end of the day. The other big side to that is if you're providing a service, you can generally phone around competitors and see what they're charging to make sure that you're charging the right figure compared to your competitors. If you're providing the same service, that is. Yeah. Obviously, if you're providing a better service, you should be charging more. Yeah. And then the other side to that is if you're buying products to resell, it's a case of looking at the wider market internationally to see if you can buy it cheaper, if you're buying bigger bulk. And is there enough market that you feel for you to sell more of that quantity? So those are the sort of things I'd suggest people look at. There is no perfect margin in any sense. Some people say the higher the better. Yes, okay, you get more profit. But you also have to be realistic because people can only sell at a certain price because people won't buy it otherwise.
So good little rundown of that then is effectively looking at your overheads, making sure that they're fit for purpose, but letting them kind of identify whether or not you're making enough margin and some of the other stuff you've mentioned as well, which is trying to improve the margin to cover the overheads, etc., which is great. Have you done a lot of this work with clients in the past? Do you have any client examples that you might be able to share?
Yes, I've worked with lots of clients on this basis. Like I said earlier, I had that large client who had lots of different avenues they'd gone down and weren't profit making. And we shrunk it right back to the core of where they were making money, and they're doing a lot better now. I have other clients who, in the catering industry, who had a restaurant here, they had in-house catering over here, all sorts of different avenues of income streams. And again, we analysed it, looked at where they were making money, where they weren't, where they could improve margins again, like we were saying, their prices high enough, where their costs too high, it was something they could change with those things. And we put all those in place and helped them to, they knew exactly what parts of their business were doing well, which parts of their business they needed to improve and wanted to improve, and it gave them such clarity about what the next steps were.
That's interesting, Ed. So do you know any other popular scenarios that this may have happened for other businesses that may be more popular brand names, perhaps?
Yeah, a very good example of that would be LoveFilm. I don't know if you're old enough to remember that, but we...
I don't think I am, unfortunately.
So LoveFilm used to operate, so you ordered a DVD and it came through the post to your house.
Oh, okay. What's a DVD? I'm going to again.
And then over time, they started streaming it on Netflix.
Ah, okay. I've heard of that.
Yeah. Well, they started looking at their two different income streams. One was sending DVDs out to people, one was people streaming, and started to realise the profitability on the streaming was far higher. People preferred that because they haven't got to wait for the film. And eventually, the way of posting it disappeared. And they decided not to have that income stream anymore, but just to concentrate on the streaming service.
Okay. That's
a very good example of people monitoring their different income streams and deciding that one isn't now fit for purpose going forward. It's not going to be as profitable. Extra costs they had, whereas the new streaming service for them was very profitable and the way they wanted to go forwards and the way people were changing their habits.
Oh, brilliant. I always thought Netflix was just there. I didn't realize there was a thing before Netflix, but that's interesting. So do you have any like key takeaways that we can break this down so we can, because there's a lot of things we've talked about today.
Yeah.
Anything that we can kind of leave the viewers with?
I think the big thing for any business owner is to look at your business and look at the different ways that you're selling products, services to customers. And look at each one in turn, in terms of the clear income you're getting from that stream, the clear direct costs that relate to you selling that product or that service, and working out your gross profit margin for each part of your business. Then once you've done that, is that the profit margin that you want to make? Now, that's not your overall profit in the business because you've still got your overheads. Okay. But when you take your income coming in, less your direct costs for each part of the business, and just review it, and it'll be a good point at that point to say to your accountant, can we just have a half an hour chat to look at all my income streams, look at my margins, because they've got a wealth of experience. Most accountants work with hundreds of clients. Yeah. Over many years, they've seen probably 1,000 clients. Yeah. And many will be in a similar situation and know roughly what sort of margins there would be a good margin in your industry. If not, they might be able to do the research and find that for you. And then you've got a target. And now you might be doing better than the average, you might be doing worse. But then you can have a look at, can you improve that? And then once you've done that, you want to monitor it each month. So you need a way to get that information easily. And that's where you probably need to speak to your accountant again about how you record the information so you can pull it off your accounting software, Xero, QuickBooks, Sage, whichever one it is. And then every month you monitor it and make sure you're still hitting those margins you want to make. And then hopefully steadily you'll see your profits increase because you're concentrating on your business and looking at how you can improve it.
Fantastic. That's a brilliant breakdown. Thank you very much. And thanks very much for coming on, talking about profit and, maximizing your profit with income streams. It's amazing. Thank you. So thanks everyone for listening. If you want to learn a little bit more about the topic, about income streams and how it could potentially help you and your business in the future, please don't hesitate to download the ebook in the link below. And if you've got a topic that you want us to discuss on a future episode, again, please don't hesitate to leave a message in the comments below. Don't forget to like, share and subscribe, and thanks for watching.